Hey, it's Mike Lynch with AmeriFirst Financial. It's time for your Monday morning mortgage update for the week of April the 11th. I hope everybody had a fantastic weekend. Gosh, sure love the cooler weather. Got out on my mountain bike this weekend and checked off some of those trails on the Bigfoot Mountain Bike Challenge. Now, I talked about this last week. If you're a mountain biker or if you just love the trails, click on the link in this video. Check out the Bigfoot Mountain Bike Challenge. It's a great community event all over Northern California, and I encourage you to check it out and see what it's all about. So what happened last week and what are we looking at this week? So last week, unfortunately, another big sell-off in the bond market. We saw 100 basis point sell-off, meaning the bond market went down, money flowed out of that bond market, and mortgage rates went up. We've been really moving in a step pattern on rates, and I want to show you a visual here. So this is a snapshot of the trading of mortgage-backed securities in the bond market. It's a 6-month snapshot. If I move all the way over to the left here, that is November, and all the way over to the right is today. In the middle of this, obviously, is January 1st. And since January 3rd, which was a Monday after the holidays, we have seen the bond market take a very, very drastic downward movement, which means money's flowing out and mortgage rates are going up. We've talked about why this is happening, but really what we're seeing is a stair-stepper pattern, meaning that rates go up, money flows out of the bond market, it moves down. When you see that downward pattern, that means rates are going up, and then it levels off. And then some other economic news comes out, rates shoot up, and then we see a leveling off. And you can see the pattern here in the yellow, and I'm circling it in red, that stair-step pattern. And we've just seen it really over the last few months. So at the end of this chart at the bottom there, are we in a stair-step pattern here where maybe we'll see these rates level off a little bit? It's possible. So let's talk about what's moving the market this week. We got inflation, we've had central banks, and a bunch of other stuff. So inflation. Inflation's big. We got CPI coming out, Consumer Price Index, PPI coming out, Producers Price Index, Import-Export reports coming out, all big inflationary numbers. The last month when these reports came out, 40-year highs for inflation, and we expect these numbers to be even higher. Folks, this is just not good for mortgage rates. And until we get a curb on this inflation, we're going to see these rates slowly creep up. Central banks is a third thing. So our Fed isn't meeting, but a lot of central banks, a handful of them around the world, are meeting their own version of their Fed meeting. They're going to look at their rate policy, and we really expect them to raise rates just like we have been doing. We expect our Fed to raise rates 6 more times in the next year. That's the primary way the Fed fights inflation, and the same for other countries. They're experiencing inflation as well. So we'll be watching what those other central banks do to see if there is a pattern of raising those rates moving forward. And then a bunch of other stuff. So oil prices are down. Less demand around the world right now. And that's actually good for mortgage rates if these prices get down low enough. If we actually see prices go to 80 bucks a barrel, which we haven't seen, that actually could significantly move mortgage-backed securities. We don't expect them to go down that much this week at all. But again, we're starting to see a pattern, starting to see signs of a slower economy in the U.S. There's some reports coming out. A slower economy is a good thing for mortgage rates. Obviously, it's not great for the economy, but as inflation is up, people are spending less money. As the Fed raises the Fed rate, that causes less money spending, and this is the whole point of it. It lowers inflation. And then consumer debt is up. Not a good sign. We're going to be watching some of those numbers roll out over the next couple of weeks. Retail sales is coming out this week, and that'll tell us if people are buying stuff. And then we have a short week. It's Good Friday this Friday, so the bond market's closed, and then it's also closed a half a day on Thursday, so it's only open in the morning. So that actually could be a positive thing for rates. So what are we looking at this week? It's a very busy week, a volatile week. Everything's dumped on the front end of the week, and then the last week we expect Thursday and Friday we expect really some calmness. So what can hurt rates this week? Inflation. Bottom line, what can help rates? If we see oil prices go down a little bit more, and if we see that long weekend cause those rates to go down. Now, why is that? Because a long weekend, typically the bond investors, people park their money in the bond market, kind of a flight to safety, so that they don't experience any of the volatility over the weekend. And so maybe some money will be parked in the bond market, which could cause those rates maybe not to go down, but at least not to go up. So we're starting the week cautiously floating with an easy trigger finger to lock rates if we see any changes. Have a fantastic week. If you know anybody can benefit this video, please forward it to them. If you have any comments, I'd love to hear them, and we'll talk to you soon. Bye-bye.